Real estate's in this really interesting place right now, specifically investment income properties, because pricing is down around 25 to 30% from their 2022 highs. And we've been hanging out in this valley low point for quite some time without any single major crisis that's brought us here. It's very different than 2008 when there were borrowers that were defaulting on their loans, going into foreclosure, and then banks were selling these homes at really steep discounts. There really is just a lot of pessimism out there, and I think a lot of this is driven by interest rates. Prices are so heavily tied to interest rates because most people are buying properties with loans. So as the debt got more expensive, pricing had to come down to offset that. There's also been a plateauing in rents. The rental market has definitely softened, and that's capped income on properties. At the same time, you have operating expenses increasing drastically, like insurance premiums and utilities. And so, if you have income staying stable and expenses going up, that margin has really narrowed out, and that's the cash flow that the property produces. That's the money that people are making on their investments. But the big story is interest rates. From 2010 to 2022, debt was basically free. Interest rates were so low. And what that did is it created a meteoric rise in the economy, specifically around real estate. And then in 2022, rates rose so drastically to offset inflation. And the fact that there's been minimal reprieve since then has really created a lot of instability in the real estate market. The motto was survive until 25 because most people thought that rates would have normalized back down to the levels where they were at previously. That's why it seems like there's a lot of risky debt out there because a lot of those loans were based on when rates were so much lower than where they are today. This risky debt or bad debt can really be described as either loans where the loan is actually greater than the property's current value. The existing loan is greater than if you were to refinance and get a new loan on the property, or the debt payments for that loan are greater than the building's current cash flow. The hope was that there would be enough of a cool down in rates to offset this risk, and many people thought that we'd be here by now, but we're not. Lower rates would help borrowers secure better debt to pay off the existing debt, the bad debt, without having to do major capital infusions or risking default. The problem is that this lower interest rate environment just hasn't come yet, and a lot of lenders have already kicked the can down the road, hoping that we'd be here by now. So we're at this weird inflection point where we need rates to be lower, but they're not. And a lot of this risky debt is coming due and needs to be paid off. Those who have played it right over the past couple of years have been able to sleep better at night and are actually in a position to scoop up assets at much better prices. The market is much more advantageous for buyers, but new purchases do come with associated risk. And I think sellers have accepted that this is where the new market is at, and they're much more willing to meet buyers at the prices that make sense for them rather than holding out for a higher price. So the way that we've been operating within this environment is to really focus on strategically operating the properties that we already own and then growing our current portfolio by finding great assets at great prices. We're hyper fixated on maintaining stable returns for our current investors, protecting their capital that's already been deployed into properties, and then looking to ride this wave up and out of this down market.